Great to see you, Thea. Thanks so much for joining me on the African Allocator Podcast.
Great to see you too, Chipo. And congratulations on your new African podcast. I'm so happy to be on it.
Yeah, that's very kind. Thank you. Thank you so much. I'm just going to get straight to it. You're the managing director of Change Global Investing. You're based in the US. Are you based in New York? Is that correct?
I'm based in New York.
Yeah, fantastic. Now, before we talk about the firm and your allocation strategies and things like that, I'm just curious to hear what got you to invest in.
So I was born and raised in Eastern Europe behind the Berlin Wall, had the privilege of watching the change, and very early on decided that I wanted to be a part of developing those capital markets.
Where in Eastern Europe did you grow up?
I grew up in Bulgaria, Sofia.
Okay.
And I started working when the asset class was forming in the late 90s. I was still in college, and my first job was to speak with governments in the developing world about the benefits of the capital markets and privatization.
Fantastic. So with Change Global Investing, could you tell us a little bit about when it was started and why you focus on emerging and frontier markets specifically?
So I started a company in 2013. At that point, I had a number of years of experience in those markets and had a pretty good sense of what the opportunity is for investment. I'm clearly very, very passionate about the work. I find it incredibly rewarding to help build out those capital markets. And I'm surrounded with a very, very good team that's pretty good at what we do. Our top 4 senior investment professionals have 20 years of average experience, and we all understand those markets quite well and how to optimize the pricing and efficiencies.
Now, you're, as I said, you cover emerging and frontier markets. I forgot to add public equities specifically. What's the difference in your mind between emerging and frontier? I think it's worth just clarifying that. For our listeners?
Yes, absolutely. So historically, the emerging markets were countries that opened up their economies in the mid-late 80s and subsequently opened the stock markets. So they were some of the first to enter the global investment opportunity set. Places like China, India, Brazil, Mexico, Poland, in Eastern Europe. The frontier markets are the countries that entered the global investment opportunity set a little bit later. They opened their economies a good 10, 15 years later. They opened for foreign investment later. So examples would be Vietnam. The entire Middle East was probably the last region to join that investment opportunity set. Today, however, the differences are not so much in the level of economic growth, but more so to do with accessibility. The emerging markets are very easily accessible for investors anywhere, and frontier markets still have some accessibility challenges, which could also be opportunities. Perhaps informational knowledge. There's fewer analysts covering the stocks. They may be a little less liquid. And there could be still some custody arrangements that would be more peculiar to the frontier markets.
In some, particularly Western investors' minds, those challenges you mentioned are reasons to run away from frontier markets. Why are you going in?
Yeah, so clearly there's an opportunity for returns that is stronger than that in the emerging markets. Emerging markets provide also different diversification benefit. Today, 70 to 80% of emerging market flows are through passive vehicles, and that makes them much more subject to global flows, global headlines. The frontier markets couldn't be more different. They're more distinct than emerging markets today than they've ever been. They're mostly dominated by domestic investors, and therefore there's more idiosyncratic factors and features which fit very well within a global asset allocation.
In a moment, we're going to talk about specific countries and regions, even companies, but just zooming out a bit from change global investing's perspective? What's shaping your asset allocation strategy? What key principles are you investing by?
Yes, so our asset allocation framework is the result of many, many years of experience in those markets. And what we have learned is that it's very important to diversify globally, but concentrate by stock. And the reason why we diversify globally is because we can look for hidden gems anywhere across any region, regardless of what our peers are doing. But just as importantly, we're able to diversify macro, unforeseen political risk. And we concentrate by stock to provide this ability for upside potential while limiting the downside. So the end result is a portfolio that historically has been driving returns through alpha generation while minimizing beta as well as volatility.
And you talk about being global. What regions of the world are you invested in at the moment? And maybe give us a sense of the kind of sectors that you like. And favor over others?
Yeah, so absolutely. So by globally, we mean allocating a meaningful exposure to all four regions. Today, we have roughly 30% in Asia, about 30% in South America, 20% allocated to Africa and the Middle East, and another roughly 20% in Eastern Europe. In terms of sector allocation, our sector allocation is very representative of the opportunity set with some differentiating points. We think of the portfolio as being allocated to three main buckets. We have the consumption bucket, which is quite characteristic for emerging and frontier markets, and that investment case is well articulated by the industry. The second bucket would be the financial services bucket, and that is quite differentiated for us. Historically, financials tended to be the banks, the big banks in the universe. For us, financial services means a focus on the capital market development. So we're specifically looking out companies that have exposure to the growth in the domestic markets. Examples would be stock exchanges, asset managers, brokers. So any type of an enterprise that's levered to the growth in the domestic markets. And then lastly, the third bucket will be opportunistic, where we have technology, healthcare, utilities, some commodity exposure, so truly diversified across all sectors.
Would that diversification be representative in your African allocation as well? Or are there particular sectors in Africa that you favor over others?
Yes, absolutely. So we do have diversified exposure across Africa. We're invested in close to 10 countries today in Africa, so in some of the bigger as well as some of the smaller countries in sub-Saharan Africa as well as North Africa. I do have a bias for the companies that are directly levered to the growth in those domestic markets. So examples would be Stanbic in Nigeria. It's by far the largest wealth and asset manager in Nigeria. It has over 40% market share. It's incredibly dominant in the custody market with well over 70% market share. So that would be definitely the bias for us.
What do you look for in companies? So you mentioned Stanbic there and this, dominance in the Nigerian market. You mentioned maybe two or three things that are absolutely key from your perspective when you're researching companies and getting to know them and their management teams better.
Yes, so our investment philosophy is actually quite straightforward. We're looking for blue chip companies that have multi-bagger upside. And what we mean by a blue chip company is a company that's market dominant in its space. The reason why we like that is because in the developing world, market dominance comes with excess profits. And those excess profits are a terrific way to invest for growth as well as minimize the downside. These companies do not need leverage. They're consistently investing internal cash flow, and they're paying out pretty good dividend yields this day. The differentiating point between us and others that look for blue chip companies is the timing. We're very adamant that we invest only when the upside is one of a multi-bagger opportunity.
What are some of your red lines? So things that will make you run a mile from a company?
Well, clearly anything that has an operational risk associated with perhaps new news related to a legal liability or management issues. Those tend to be quite rare from our experience. We've only really had 2 or 3 such examples. Typically, we sell a company when it reaches its full price potential. We look at valuations relative to historical multiples, relative to sector averages, but also relative to the portfolio. Today, the portfolio is trading at 8 times trailing PE with a 6% dividend yield. So these are very unprecedented valuations. It's hard to sell stocks. And we also have a lot to pick from. So our job is the hardest part about the job today is to ensure that we're sufficiently concentrating the portfolio when there's so many opportunities across the board.
So just going back to your point about stock picking, would you describe your approach as that of a value investor? Would you describe change as a value investor or not quite?
I would describe us as a very picky investor. Clearly, we're investing in those markets for growth, but we also want significant upside. We're not traders. We don't get involved when the upside is 15, 20%. We get involved when we see a 4 or 5x multiple upside. And so the end result is a portfolio that has pretty strong growth profile. Right now, we're anticipating close to 25% earnings growth for the average weighted portfolio company. And we are doing that with very attractive upside. I mentioned the 8% trailing or 8 times trailing PE, which getting us close to historical averages, including dividend yield and earnings growth, adding up all those 3 sources of returns, takes us in the mid-teens annualized 10-year projected returns.
Well, which countries in Africa are you invested in? I think you mentioned you invested in 10 countries. Can you give us a sense of what those are?
Yeah, so we're heavily invested today in Nigeria, Tanzania, Kenya, Morocco. We have some exposure in West Africa. We also have some exposure in the smaller countries in East Africa, such as Uganda. And I'm headed to Ethiopia in several weeks, where we're hopeful to work with the newly opened Ethiopian Stock Exchange to help build out the custody arrangements that would ultimately allow foreign investors like ourselves to participate in the domestic market growth.
That's fantastic. Now, one of the big challenges of investing in Africa, one of the sort of most well-known is, so investing as an international investor, I should say, is just FX risk. I'm curious to hear how you approach it. What's your attitude to it? How do you manage that?
So historically, FX risk was very effectively managed by diversifying country exposure. And that was because at times one FX would work, appreciate, others may depreciate. And ultimately, within a globally diversified portfolio, the FX risk was not a significant driver of returns. clearly everything has been flipped upside down in the past 10, 15 years. We've seen a global dollar strong event, which affected negatively all currencies across the world, not just in developed, but also developing frontier African markets. And so global diversification by country has not been as effective. And that is why we adjusted our portfolio construction and thinking by demanding more in terms of prospective returns from our investments. When I first started out, I was looking for stocks that can double in 5 to 7 years. We adjusted that target to stocks that have that 4 or 5x within that time period. And so what that means for our stock selection, again, looking at the three sources of returns, on the earnings side, we're looking for companies that have a stronger growth profile. On the dividend side, we're looking for companies that are ramping up dividends or share repurchases, which has been the case as of recently. And lastly, on the multiple side, we're looking for companies that are trading at a bigger discount to their historical averages to ride out a stronger re-rating upside.
Have you had an experience where, when your particular company has hit that multiple and you're looking to exit an investment, it's been tricky because of, maybe say dollar shortages or, that kind of thing? Have you had any difficult experiences around, exiting investments and currency?
We've never been forced sellers. We have been very fortunate to have investors that are long-term oriented, that truly understand what we do and what the opportunity set is. That said, I do want to emphasize that those lockups are extreme situations in the developing world. Sometimes we tend to focus on those as if that is the norm. Lockups do happen. They tend to free up. And to ensure that one can ride it out, one needs to be very thoughtful and selective about the type of investors that come into those markets.
Now, from your perspective as a US fund manager, what opportunities and challenges are peculiar to invest in Africa?
Yeah, so I would say that the most peculiar challenge about investing in Africa is that dramatic gap between perception and reality. It's a challenge because we have to work so much harder to educate investors, especially in this country, in the US. Less than half of the population has passports. So traveling abroad is not the norm, and certainly not to Africa. It takes a lot more legwork to educate. What we have found is that taking investors to the region on the ground tends to be transformational. They become believers. And on the contrary, the reason why that's also an opportunity is because this gap between perception and reality creates pricing inefficiencies. I like to say that in my work, I arbitrage one with the other. And I find it very professionally as well as personally rewarding.
Well, that's one of the goals of this podcast, to educate a global audience about, the African opportunity set. So yeah, we're playing a part as well in that. Thea, just a final question. Q1 is nearly over. Q1 of 2025. As you look to the rest of the year, as you look at African markets for the rest of 2025, what are some reasons for optimism and some reasons for caution?
Yes, time has gone by very quickly. I can't believe it's almost March. So I am quite optimistic about the African markets. They are beyond inflection point. The markets are re-rating, liquidity is improving dramatically. And this is all happening on domestic investment flows. So I'm super optimistic that if we do see some foreign flows return, we will see very, very attractive returns. On the latter part of your question about possible concern, well, with Africa as well as any developing country and market, one has to be always watchful about signs of regression. We're investing in those markets for change, for transformation, for the notion that they continue on the reform path, that they continue opening up to foreign investment, domestic investment, and any sign that may not be the case or that they're taking a dramatic step back would be a concern to us.
Fantastic. Yeah, thank you so much for a really interesting conversation. I appreciate you joining me today. Thank you.
Thank you, Chipo. Best of luck. I'm excited for you.
Thank you.
Take care.